Online at pointofview.net. This is Bible School Radio, KDKR, Decatur, Dallas, Fort Worth, and KYJC, Commerce. Online at kdkr.org. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, what are the 15 things to keep in mind for filing your taxes 2022? Part 2. Today we're going to take a look. Stay tuned for Prudent Money. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, yesterday we talked about what you need to know when it comes to filing your taxes for 2022. Today, Dan Pilla, IRS expert, is back with us to finish off that list. Dan, welcome back for part 2. Sorry to put you on the spot yesterday to see if you're free today to come back on, but I thought, I've known you for over 20 years. We've probably done at least 200 shows together. Why not ask?
Hey, well, I'm glad you did, Bob. I'm always available to help you out and especially help your listeners out. So it's no problem. I've got a hole here in my schedule, and so I'm happy to talk to you.
Well, good. Let's talk a little bit about, and some of this is going to be repeat just because I want to make sure that everybody got the information that they're going to need. But the particular situation I know that concerns you the most is that situation where you owe the taxes, you got April 18th coming up, and you have the money. So talk a little bit about what you do in that situation again.
Well, let's first of all talk about what not to do. A lot of people will fail to file the tax return when they don't have the money to pay the tax. They think they better not file the return without the money or they're going to get in more trouble. Actually, it's the other way around. When you fail to file the tax return without the money, the IRS adds the failure to file penalty to the failure to pay penalty, and that can double the penalty hit. The failure to file penalty is up to 25% of the tax. The failure to pay penalty is up to 25% of the tax. And so now you're looking at 50% problem instead of a 25% problem or potentially 25% problem on failure to pay. So don't fail to file the tax return just because you don't have the money to pay the tax. If you don't have the money to pay the tax, there's a couple of options here. First option is IRS Form 1127. Form 1127 is called an application for an extension of time to pay the taxes. And what that form does, Bob, is it can give you up to 6 additional months to pay the tax without penalties. Now, the thing about that is it's not automatic. The filing extension is automatic, but the payment extension is not. So in order to get this extension granted, you have to demonstrate to the IRS that you do not have the capacity to pay on time, that failure to pay will cause some kind of a hardship, or that circumstances beyond your control put you into a position where you couldn't pay on time. All right, so there's got to be a showing. There's got to be a factual presentation in the form as to why you need the extension. And it's discretionary with the IRS. They don't have to grant it, but if you give a good reason why you don't have the money and you will have the money within 6 months, you can get this extension, right? So that's option number 1 is Form 1127. Option number 2, Bob, if you can't pay the tax on time, is Form 9465. 9465 is called an installment agreement request, and that'll set the wheels in motion to get you set up on an installment agreement to pay the tax over time. In either situation, you have to file the return on time, or they're going to stick you with that failure to file penalty. So I don't want people to get clobbered with that penalty when they don't have to. There's 2 options here. There's actually a third option. We can get into that if you want to. But these are the 2 obvious options, and the 2 simplest options are to request either the extension of time to pay if you think you can pay within 6 months, or if 6 months is not going to be enough time, then use Form 9465, the installment agreement request.
Yesterday, you also talked about what to do about digital asset transactions. And I want to take a little bit of a deeper dive into that and ask a few questions. First of all,
sure.
Define what you mean by digital asset.
Well, a digital asset is any type of digital currency that operates in place of the regular U.S. currency. So what I'm talking about here is anything like a digital representation of value. So we're talking about bitcoins and cryptocurrencies and stable coins. All of these types of things constitute digital assets, Bob, and digital currencies, and they have to be depending on the situation, you have to report by checking the yes or no box whether you had any transactions in digital assets during 2022.
And talk a little bit about, you mentioned that there's a box, yes or no, that you have to check. Who must check the yes box? Can you talk a little bit more detail about that?
Yeah, absolutely. You check the yes box generally in one of two scenarios. If you either received a digital asset, and when I say received, you got it as a reward, you got it as payment for services, you got it in exchange for property that you transferred. So in other words, you sold something and you got digital, you got digital assets for it. Then you have to check the yes box. The second circumstance is if you disposed of a digital asset, you sold it, exchanged it, gave it away, or in some other way used it to transact business. That constitutes a sale or exchange. So in either of those two circumstances, and they're very broad, Bob, as you'll agree with me, these are very broad scenarios. So for example, I'll just give you an example. If you have your Bitcoin wallet and you went to Burger King, all right, and you buy a cheeseburger at Burger King with your Bitcoin wallet, I don't even know if they do that, but just I know there's a lot of places that are taking Bitcoin in exchange for their for goods and services. If you did that, then you essentially disposed of a digital asset, and you have to check the yes box on the tax return.
Now talk about when you don't need to check the yes box.
All right. Well, you don't have to check the yes box if you simply owned the asset. In other words, if you've got an asset that you acquired years ago and it's just sitting there, all right, merely holding the asset in your wallet does not constitute trading activity, and you don't have to report that. All right. If you moved your asset from one wallet to another that you yourself control, so it went from wallet A to wallet B, that's not a sale or a disposition. You're just moving it. It's like moving money from bank account A to bank account B. That doesn't matter. And then purchasing digital assets using U.S. currency, acquiring the asset through purchase, then that doesn't mean then that doesn't have to be reported either, because you're acquiring it. You're not disposing of it or selling it.
We talked a little bit about this yesterday, about there's not, with these digital transactions, there's some of these companies are a little bit sketchy maybe, that don't give you all the information that you need for taxes. And so it ends up being on you to figure out, okay, I used this Bitcoin in this transaction, I sold it, I made this profit. So if you go through the process of piecing the puzzle together, figuring out what taxes that you do owe, does the IRS come back and say, okay, that looks good, or will they challenge that?
Well, they may challenge it, Bob. It just depends. The only way they would challenge it is if they select the tax return for audit. So in other words, when you file your return and you report asset sales, it doesn't make any difference if it's the sale of a business asset, if it's the sale of a collectible, if it's the sale of gold and silver, if it's the sale of diamonds or Bitcoin. None of that matters, all right? All of those are considered capital assets, and essentially they're all treated the same. And what I mean by that is, let's just say we're talking about a diamond. Let's say you invest in a investment-grade diamond. You spend $5,000 for a diamond. You've held the diamond for 10 years, and in 2022 you sold the diamond for $8,000. In that situation, Bob, you have a long-term capital gain equal to $3,000. That's the difference between what you paid for the diamond and what you sold the diamond for, right? So that $3,000 profit is taxed as long-term capital gain. Exactly the same thing happens with Bitcoin. If you bought Bitcoin 5 years ago and you paid $10 a coin, and you sell it in 2022 for $13 a coin, you've got $3 per coin long-term capital gain, and you're taxed on that. All right, so now when you submit your tax return and you report that transaction, you're not going to get a letter from the IRS that says everything looks good. If everything looks good, you're not going to hear from the IRS at all. If everything doesn't look good, then you're going to get some kind of a notice from the IRS. And typically speaking, in a situation like that, like this, what we're describing here, is you're going to get an audit notice. The IRS is going to want to audit the tax return. They're going to want to look at your books and records to make sure that you reported the transactions correctly and paid the tax on whatever your gain is. All right, so the IRS has 3 years from the date the tax return is filed in which to audit that return. So that's the 3-year rule. And the 3 years, again, goes from the date of filing the return. And so that's the window of time that you need to keep your records at a minimum. I recommend people keep records for 6 years, but at a bare minimum, you need to keep these records for 3 years because that's the window of time the IRS has to look at that tax return.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Dan Pilla is on the program again, back today to finish up the 15 things you need to know about filing your taxes in 2022. We are, though, taking a second to talk about digital assets. And I think one thing to mention, just in the event that anybody's thinking this way, last year, a lot of people took huge losses on Bitcoin on paper. And I think it's also safe to make sure that people understand there's really nothing they can report on their taxes unless they, once again, go through a transaction.
Yeah, you're exactly right, Bob, and that's a good point. Paper losses are not realized losses. They're unrealized. And what's the difference between realized and unrealized? Well, the difference is, did you sell the asset or didn't you? All right, so if you buy the asset for $10 a coin, and you bought the asset 5 years ago, and now it's worth $5 a coin. Well, on paper, you've got this $5 coin loss, but you don't realize that loss until you actually sell your coin. All right, so it's a paper loss. As far as the tax laws are concerned today, right now, you are not taxed on paper gains or paper losses. You actually have to sell the asset. There has to be a sale or disposition of the asset in order to realize the gain or loss. So that is important to understand. Now, just as a side note, of course, Congress is trying to change those laws. We don't need to get into all of that because it's first of all, it's convoluted and it doesn't make any sense.
No,
Bob, none
so
whatsoever.
you say.
But secondly, it's not the law yet, so there's just no point in talking about it. But the bottom line is, unless you have a sale or disposition of the asset, in other words, you get rid of the asset somehow, trade it for other assets or sell it outright or whatever, you don't have a realized gain or loss. It's unrealized, and there's no tax consequences on that until you until you pull the trigger on a disposition.
If you want to get more information on Dan, go to his website at www.taxhelponline.com. There's a ton of free information on the site. Go check it out. Let's get back to the list that we started to try to get through yesterday, and I knew we wouldn't. There's a lot of great information on this. You're talking about the 15 things you need to keep in mind for 2022 taxes, which the filing date is April 18th, not 15th this year. And one of the items you pointed out was expiration of certain health-related credits. Talk a little bit about that.
Well, yeah, there was a whole host of credits in the Internal Revenue Code, Bob, that were added in, and the credit for sick and family leave, for example, for self-employed people, that was allowed to expire in 2022. So those family leave credits for self-employed people, they're not applicable anymore for 2022. So that's something to keep in mind as well.
And then the next one is, what do the listeners need to know about the credit for child and dependent care expenses?
Yeah, what happened is under the American Rescue Plan. Well, let me go back before that. The child credits and dependent care credits have been in the Internal Revenue Code for quite some time. What happened is with the CARES Act and with the Consolidated Appropriations Act at the end of 2020, Congress significantly increased the child care credit and increased the age at which the child credit applies. It went up to 18 years of age. And now those are back down again, all right? So the credit, the dollar limit on the qualifying expenses is $3,000 for one person and $6,000 for two people. That's back down the way it was, and there's also some adjustments. Now, I know that we're moving fast through this stuff, and a lot of people don't catch the numbers and so forth. What I recommend that people do with this stuff, Bob, is if you're not sure about it, get IRS Publication 17, Publication 1-7. Is called Your Income Tax, and it's downloadable. It's a huge document, and it's fully indexed. This is one thing that the IRS did right, Bob, is they produced this. They produced this. I don't.
That's a first.
Not my job to defend the IRS, but I got to tell the truth here. This Publication 17 is pretty darn good. I mean, it's very thorough and it's very well indexed. So you can go to the index and you look for child credits and dependent credits and sick leave and all this stuff we're talking about, and it'll give you a hyperlink to the page in that Publication 17 that talks about that, and it will give you the lowdown on what it is. So that's going to be helpful for folks as well.
Dan, is it my imagination, or have they just taken this and overcomplicated it to the point that people just will never get it? I mean, it's just unbelievable, the amount of detail, changing, shifting, changing back, and whatnot.
Well, that's probably the number one problem with the tax code that we have, Bob. And just to give you an example, in the year 2020, so we're talking, 22, 23 years ago, the tax code consisted of about 1.3 million words. Now, that seems like a lot of words to me, but what happened over the next 20 years is the tax code grew to its present state of over 4 million words. All right, so from 1.3 million in 2020, so 22 years later, we're at over 4 million words, and all during that period of time, Congress was simplifying the tax code. Right? This is insane, Bob. Over that period of time, there have been more than 6,000 changes to IRS code sections and subsections, and people have no idea how to keep up with this stuff, none whatsoever. And the credits are complicated, the deductions are complicated, the write-offs and people simply don't understand. What we have here is the number one most serious problem that people have in complying with the tax code is the complications. And the complicated tax code has two primary problems with it. Number one is it actually creates a disincentive to compliance. The more complicated the law is, the more likely people are to throw up their hands and say, forget this insanity, I'm just not doing it. Right? The complicated tax law also sends the message or it helps reinforce the message that there are people out there that aren't paying what they owe because they're somehow taking advantage of the complexities in the code to get benefits out of the law that other people don't know about. So we've got this perception of unfairness because the tax code is unfair, and we've got a daunting task for both taxpayers in complying with the law and the IRS in administering the law. And this is the other thing that sends the wrong message to the public. If the IRS itself doesn't even know the law, which they don't, if they don't know the law, how can we be sure that people are really, truly paying what they owe? And the answer is we can't be sure, and there's no way to be sure. And this is why there's such a broad, unfettered perception out there that the tax code is unfair and is being administered and enforced in an unfair way. And depending on who you ask will depend on who is getting the unfair advantages. If you ask the lower income guy, it's the high income people that get the advantages. If you ask the high income people, it's the low income people that get the advantages. And frankly, Bob, they're both right. I mean, both sides of the economic spectrum are to a certain extent taken advantage of by this tax code. There's just no question about it.
You know, it makes me wonder how much money could have been saved that's just left on the table.
Well, there are massive amounts of money that are wasted, just abject waste, in complying with the tax code. All right, we've done studies years ago, and these studies are old, and so the numbers are stale. But they're worse. They just simply have to be worse now than they were then, because we looked at this question back in the mid to late 1990s, long before the code exploded to 4 million words, right? So back then, we determined that the compliance costs were about 65% of the amount collected. Now, when I say compliance costs, I'm talking about the costs that the private sector, individuals and businesses have to bear to comply with the tax code. It costs you money to make and keep records. It costs you money to have your tax return prepared. It costs you money to deal with IRS notices and audits and so on, right? Those are all compliance costs. And when I say 65%, what I mean by that is for every dollar you pay in taxes, it costs you another 65 cents to get it there. These are massive costs that are sucked right out of the economy, and so it's equivalent to taking the productive component of thousands of workers, Bob, and just dropping their productivity into the Atlantic Ocean, because it produces nothing. Tax law compliance costs produce nothing in terms of increasing the wealth of the nation. Now, you'd say, well, Dan, what about all the accountants out there? Well, yeah, there are accountants out there, Bob, but no, let's think about this for a minute. I'm not saying accountants should be out of work. They shouldn't be out. Here's my point. Even if the tax law was gone, there's still a legitimate place for accountants in businesses. Businesses still need accounting work done. So it's not that accountants don't produce valuable asset or valuable results for their clients. They absolutely do. I'm just saying that those efforts would be put someplace else where there's actual productivity that's gained, and not just this waste of time in tax law compliance. That's what I mean by that.
Once again, Dan's website is www.taxhelponline.com. We've got about a minute left. Talk a little bit about the Earned Income Tax Credit.
The Earned Income Tax Credit, Bob, is the number one welfare program in the United States that's operated by the IRS. There are a number of welfare programs out there. We all know that. But the Earned Income Tax Credit is a credit that's available to low-income people that actually gets them more money back. It's a refundable credit, meaning it gets you more money back from the IRS than what you paid in. Now, the Earned Income Tax Credit is a very complicated credit, and it's one of the areas where the IRS has identified the most fraud among low-income taxpayers, all right? So when we're talking about low-income taxpayers getting audited, the audits are almost always targeted at the Earned Income Tax Credit. So you as a taxpayer need to be aware of any tax professional that's encouraging you to claim the Earned Income Tax Credit. If you're entitled to the credit, then absolutely claim it. But you need to understand the basics about the credit, because it is such a area of wide abuse. And so go back to that publication 17 that I mentioned a minute ago. Read on the Earned Income Tax Credit and understand at least the basics of it, if not all the nuances, so that you can be sure you're not filing an inaccurate tax return if you claim the credit.
It's great information, Dan. Once again, www.taxhelponline.com. Dan, thank you so much for coming on part 2 today, and just great information. You're such a blessing.
It's my pleasure, Bob. Thanks for having me. I appreciate you.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. I was thinking about this. I've known Dan about probably a little over 21 years. We've done at least a couple hundred programs together throughout those years. And it just amazes me what you have to know about just some of the simple processes of filing a tax return. But taxhelponline.com is where you'd want to go for more information. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.